Okay, welcome to the video that's going to discuss the no demand, no supply signal, standard VSA. So we're going to look at, first of all, the traditional definition, and then we'll get into some more of the nuances. So to start with the traditional definition of no supply, firstly, the volume. This is that candle. The volume has to be lower than the previous two. So we see that there. That doesn't have to be a big difference. We're just giving you the technical definition here. So it's lower than the previous two. That's the first thing. Also, the candle has to be bearish in the case of a no supply. If it's a no demand, it has to be bullish. So it's basically just the opposite. So a no supply has to be bearish, red candle, and it also needs to, I'll zoom in a little more, close off the low. So there has to be some sort of pin there on the bottom, at least something. So a solid close down at the bottom would not be a no supply. So that is the technical definition, and we'll look at that, we call that a potential no supply until it's confirmed on the next candle. So once price moves above the high of this candle, then it's considered confirmed. And that's often an entry point for many VSA traders, very common textbook entry there. So to get into a little more about, you know, the different ways that you could handle it and trade it, and some of the nuances here. I wait for a candle to close to confirm it 90% of the time, most of the time. And, you know, it's like looking back, there are losses that I've taken that I would have avoided had I waited for the close. So, you know, every time that happens, I get more, and I'll do it less and less. And so I'm now at the point where I barely, you know, I usually wait for the close. And, you know, I see entries go by that I don't take that wouldn't have worked out. So I'm doing that, you know, more and more almost every time now. So if not, you know, I'm waiting for the last, at least the last 30 seconds or so. So in this case, you know, waiting for that to close for a long entry is valid. Some VSA traders would set, you know, an entry order a couple of pips above a high and just let the market come up and hit it or not. I personally don't do that, but that's common. I think if you wait for the candle to close, and you know who knows what can go on before a candle is finished, and you let that happen, you have a slightly better probability on that trade, because of course you can have a scenario where price moves up. You get your order in, but by the time the candle closes, you know, in the last 30 seconds, whatever, it pushes down, even makes a new low. Anything can happen. It can push up there in the beginning of the candle, and who knows what for the next, you know, 5 minutes may go on. So I like that close gives a little bit of probability, confirming that. I guess the downside would be you may you know you'll get a worse price, entry price often, because you know a couple of pips above there, you know, you're getting right in. If you're waiting for a close, that close could be anywhere. It could shoot up and you don't get an entry at all. So depends how aggressive you want to be. But you know, there's two sides to it. If you wait for that confirmation, you're not getting as good of a price. You'll make less pips in the end, most of the time. All right. So let's see. I have some notes. I'm somewhat prepared here. All right, what would cancel out this potential no supply? Of course, it would be a close below. So price is allowed to come below that candle, but as long as it doesn't close below. So you'll end up with a pin on the bottom. And if anything, you know, a pin on the bottom and a close above would be a sign of strength. So, but that's the rule I go by. If price were to sit here for a couple of candles and then confirm, that's valid. But as long, as long as there's no close below this initial low that's made here. So those closes really matter to me a lot on the 5-minute. So of course, needless to say, I keep the 1 hour in mind, the 1 hour phase, and I trade along with that. So this long setup could come during a markdown, and I wouldn't even be thinking about entering. Or usually not. Very rare that I would do that. Go with the phase. Phase is your friend. So of course, keeping that in mind. In these examples, we're not even going to talk about background. We're just isolating these little things. So that's a no supply, and then of course you have the no demand, which is the opposite. Let me just check something here. Okay, so here's the no demand. There's one. Volume lower than the previous two. Up candle, in this case, because it's a no demand. Closing off the high there, you have a pin. And no close above it was made. So it's considered confirmed once it moves below or closes below, depending how you do it. This was technically a close below here. So that would confirm it there. So it's okay that this candle didn't confirm it. It's still valid because, there wasn't a close above. Okay, so we have that standard stuff, that all nice and clear there. So I'll just talk about some other things, show some examples, other questions that may arise. All right, well, this is just a recent example. I mean, this is just today. So just to point out, here is a no demand. It's valid. Volume there, candle, close below, and that would be a valid short entry because we do have this weakness in the background. So looking at this little picture here, the widespread up bars at high volume, the inside reaction, the buy climax and all that. So you even have the fake breakout right back into range on high volume. So all that stuff shows weakness. That's when you want to start looking for the no demand. We'll talk about a little more about where exactly to look for it. So it pops up there and it doesn't go. There's your entry, and immediately you have drawdown. But the thing is, so I'm getting a little more into the entries and all that. On these reversal trades, because we have a move up and then we're looking to short on the climax, look for a reversal. Ideally, you want to get your stop. This is going to save you a lot of times and get you into profit and not kicked out of the trade. If on the reversals you have your stop loss completely outside, in this case above the top, 5 to 10 pips above. So this trade would have worked out just fine. And, looking at that and your one-to-one risk reward and looking at your risk and all that stuff, I'm not going to get into that. But ideally, you want your stop on the other side. And if you can't do it, just know, if you have a tighter stop, it may get stopped out. And you can either skip the trade if that ends up being like a 70 pip stop and it's just too much. You can skip the trade, or, you can go with a tighter stop and take that risk, just knowing that there is, that risk that you could get stopped out, it could continue. So, just to show the reality of what happened today, there was a no demand. It didn't just take off. Anything could happen. But it ends up being a winner, and then when this one showed up, that's what you're looking for. And so often, you get the weakness, you get the range. You may or may not get no demands throughout it, but when it finally does break and get out of there, you do have this no demand stuff happening very often. So it could have been there, that's the reality. One more little thing is I was considering this short, and what made me skip the trade was, I almost took it. I wasn't sure, but I ended up just kind of being more conservative, and I'm positive for the week, so I just skipped it. But this was one of the reasons was this was really a sign of demand coming in. So you're talking about the weakness in the background and the short entry. That I was thinking, with this sort of reaction on high volume, weakness comes in, sure, but we want to see a lack of buying, and a reaction like that is just a sign of strength. That large pin on the bottom, just stopping that down move on high volume. And so that would be a reason why you might want to get below this level or break through that. But the thing is, that's something to keep in mind, where when you're looking for these no demands, that you have a clean weakness in the background and not any sign of strength coming in like that. So that caused me to skip the trade. I saw this, and I guess by this point I had called it a day by 16 GMT. All right, well, just to show that. And that ended up being a little trouble on the trade, but it made it through when it came back to that level and showed that the demand was no longer there at a level that previously had demand. So, that's something also a good point to make, is that if you have a previous level of demand that is tested and shows a no demand, that's a nice clear signal that you should be able to get through that. It's very logical there. Let's see. This video might be a bit long, but I guess that's okay. I just marked a bunch of other examples somewhere in here. Yeah, things to look for. Other nuances involved. So in this case, you have the weakness shown, widespread, high volume, not making any progress up. We're not looking at our background. We're just looking at these isolated examples. And then to get out of this range, you have no demand right there, volume lower than the previous two. Up candle, closing off the high, and then it's confirmed here. So technically that's an entry, weakness, and a very, very simple, clean entry. So, but the one thing I would point out about this is this is right on the line as far as me defining this as a no demand. This is something that I personally do differently. Is I wouldn't look for a no demand. Not that it can't play out, but I don't think the probability is as good in this area. Once you're testing near the top, and you've seen my other videos too, how I mark the wick area as an important area of supply here in this case. So I wouldn't look for a no demand up in this area. I'd like to see it pull away. The reason why is low volume here in this area can be a lack of sell pressure, so it could continue up. You have to think that the higher prices should be bringing that supply if we want that weakness to be coming in. So to have price come up and not see volume kick in, it could be the lack of that supply coming in for it to continue. I notice when it looks like, from years of looking at charts, when it looks like it could be the end of the move, but it ends up continuing, you're going to have that same situation where you don't have a lot of volume up there because that supply is no longer able to keep price down. And so that's something, the way I deal with it. And so this is an example where it's right on the line. It's not quite in this area, so it's just barely valid. It just made it. It looks like as a no demand in my book. So. It's like, I guess the general rule could be this is an area of supply. You're looking for supply to show up there or not show up there. This is an area of demand. At this point, we can say that because with weakness showing up, it's still been able to hold price up for 5, 10, 15 minutes. So there's enough buying in here to hold price up against that weakness. So we can call it an area of demand. So then we have no demand in that area. So that's the general rule. Look for no demands where there should be demand. Low volume up here can mean a lack of supply. Continue. All right. I think this video might be a bit long. I'll keep going though. I guess I can edit it down if I need to. If I'm editing it, then it'll end right here. All right. I'm still here. Okay. Warning. This is just the notes I put. So, all right, if we're talking about this weakness here. Now, let's say this wasn't a no demand, but we saw this weakness and it starts moving down. We could still look for a no demand now. But this is just an example, just scrolling back in some recent examples of some things that can happen, where a widespread down bar like this, down candle, is not something that you want to see as far as looking for your entry in this situation. That could be, especially looking to the reaction it didn't make any progress. It turned back off of that. These wide candles are easily reversed. Easily reversed. You'll just notice that repeatedly, that when you get a a bar that sticks out like that, that's much wider, that often it reverses that just as fast. If you never noticed that before, just take a step back and look. An AR, I didn't even get to the automatic rally, but I don't know if I'll cover that in this video. So that's a warning sign. I wouldn't be looking for that. No demand after that. Nope, that was your chance. Maybe coming up to test here, but all right. Let's see. I got other examples somewhere. Okay, this is another point that I can make here. Again, I don't even know what phase this is in right here. Just looking at this isolated situation. So let's say we're in a markdown on the 1 hour. We're looking for shorts only. We have price is going to give you these type of opportunities in a strong trend where you have these pullbacks that show no demand and then continue. So let's say we're in a markdown here, and obviously it looks like we are. It's a downtrend. Haven't hit stopping volume. So here's a no demand after a pullback during a strong downtrend, and you get the no demand there. Continues. Again, you get the pullback. It ends off with the no demand. Continues. So as long as you don't see, as long as you're looking for shorts based on the 1 hour, and it's a trending, and how to catch these little pullbacks in a trending move. A couple of clear examples there. Another thing to say about this is, if you notice these retraces, they're not going to 5618 fib. There's a difference. This video is packed with good information. There's a difference between pulling back to this area and not, and seeing a no demand sooner and falling off like that and giving a continuation signal. You're going to want to see volume come in here. So I wouldn't look for a pullback to a fib area and look for it to come in and give me a no demand and an entry. No way. Fib area, this 5618, if you haven't noticed by now, is so important. And the sell pressure needs to come in here. We need to see increased volume when you get into fib zones, the sell pressure to continue. So we wouldn't look for that pull and no demand the way this sets up here. This is sooner. Maybe it has to do with other fib levels, but to me it's irrelevant. As long as it's not in here, or coming up on the 50 fib, then I'm fine with it. So that's a big point there. Now sometimes it depends on the situation, but sometimes I end up taking a trade that is a little different point here, but I end up taking a trade that is close to a 50 fib, and we know that that's a dangerous spot where price can reverse. And it just basically is adding risk. It doesn't mean that you can't take the trade every time. If I really like this trade, I wouldn't mind getting in so close to fib where it could reverse. A slightly different point but buying into a fib area, this is just a good point to mention that when I think of that. Normally something I don't want to do, it definitely adds risk is what it comes down to, the probability. But when the setup's really good, and everything looks good to the left and the whole picture and all that, so then I don't worry about it so much. All right. Back on track with this. So you notice the retraces, just taking the obvious swings. In this case, wrong thing. Taking the obvious swing, drawing a fib, seeing it pull back. See, this no demand shows up. It's all good because it's not up in here. If it was, we would need to see increased volume and like a buy climax type of activity. All right. I think I covered a lot of stuff here. I hope that's everything. I think the last thing I could say is why they work in the first place. I don't think I have any. Oh. Okay, that was that fib stuff I was talking about. Here's a no supply. Okay, if you have a down move, pull up, there's a no supply. and that's confirming that no supply right there to enter the long. But look, you know that there's additional risk because you're at 50 to 618, and it's only really if the setup looks great that I'm going to be buying right there. Otherwise, if it could pull back and I can get in lower, that would be better. Let's see, did I mark any others? What did I mark here? That's a good example here again of the fib. Strength in the background, you get the no supply, and the entry is right into a fib. It's right at 618. It didn't break yet. Not a good time to enter. But if you notice, and of course it's stalled in there, but you notice once it cleared that area, again, it gave a no supply up there where there was supposed to be supply, and then there's no supply. And there's the confirmation of a no supply, and you're way above it here. So you can have a clue that that's really going to come out of the range at that point. All right, and the last thing I was going to say is why they work in the first place is the balance of supply and demand. And just to go back to this example, we have a down move. Supply is in charge here. There's more supply than demand. Price is moving down. You have demand come in. We know that. And then at this point you have not only supply but demand. So you want to see the lack of supply. That's going to explain this in the other series. The lack of supply is what's going to have you expect the up move now to occur. So, we're looking for the imbalance in supply and demand. So knowing that demand showed up is nice, but there could be more supply and it could continue. So it's the lack of supply that's going to bring higher prices. So you have the imbalance, demand, and I mean, to be technical about it, it's not no supply. If there was absolutely no supply, price would go up, shoot up like crazy. So technically, it's not no supply, but it's a very, very small amount, relatively. So it's the balancing act, supply and demand. So it's great that demand shows up, but until there's a lack of supply, there's not really a good enough probability to take trades unless you want to be more aggressive. That makes it much more conservative entry to wait for that imbalance to occur, and often you'll find a trade that goes immediately into profit because you're getting in right on that point of imbalance. At this point, demand overcoming supply, not enough supply to stop it at the point where there was supply before, and there's the immediate reaction into profit. Now from there, again, if your stop is on the other side of a reversal, you would sit through all this, and then you can end up with more on that trade. So it did catch the point of that imbalance, and it played out immediately in price. But in the real world, that's why we put our stop here. It's because the probability of it, messing around in this range and continuing is fine. But once it gets below here, then obviously there's enough supply to continue downward, and that's a whole other story. But getting caught by those fake breaks may be a little that risk there. It's always a pain. But 5 to 10 pips below the bottom, and seeing how big that is, and from a 5-minute point of view, shouldn't be 60, 70 pips stop. It should usually be 30 pips or so. But anyway, that's another story with risk, reward, and management and stuff. So I think I'll end the video here. Covered a lot of stuff. Hopefully helpful. Thanks for watching.